All right, guys. We are going to have our mega class on Thursday, March 2nd. So, I will go over the rest of the um open economy part. So let's get started. So what we have already said in the previous lecture is that we are trying to establish two most important ideas in international economics. One of the ideas is called exchange rate, and one of the ideas is called balance of payment. Um, so previously, we have already discussed what is the exchange rate. So exchange rate are the trading ratio between the currencies, between the domestic currency and foreign currency, right? And we also introduce two of the important terms in um, exchange rate. That is the direct term of the exchange rate and the indirect term. As we know that the direct term of the exchange rate is um, how much foreign currency that you could exchange for if you're using one unit of the domestic currency, whereas indirect term is measured by how much domestic currency could exchange for if you have one unit of the foreign currency. Okay, and we also introduced the idea of the appreciation and depreciation. So appreciation basically just means that your dollar worth more. So appreciation means appreciation of the domestic currency. It means the direct terms of the exchange rate will goes up, right? Because $1 of one unit of the domestic currency could exchange for more units of the foreign currency, and vice versa in depreciation. If the depreciation happens in the domestic currency, that means the domestic currency worth less. So in a direct term means one unit of the domestic currency could only in exchange for a smaller amount of the foreign currency. Okay, and this is the graph that we showed you in two lectures before. So this is the direct exchange rates between the Japanese yen and the US dollar. So as you can see, if US dollar appreciate, then if we're using the direct terms with the respect to US citizens, then it's going to upward. Whereas if you're using the indirect term of the exchange rate, the dollar appreciation, you will see the downward sloping curve that if we use the indirect exchange rate. So this is the indirect terms, and this is how much US dollar is equal to one unit of the euro. So if the dollar was appreciating, means what? Means euro could only buy less, the same amount of the euro could only buy less US dollars, right? So this graph and this graph actually showing you the same thing. They all show that both of them are showing you that the US dollar appreciates, but just because they're using the different units, the different way to measure the exchange rate, so that they have the different trend here. This is very important. Then we talk about the long-term trend of the exchange rates, and how would you take it as one of your asset. So we give you the example of the importing car and exporting software. So I will just skip this one and also give you the example of the firms that are exporting and importing the goods at the same time. Okay, and the second biggest concept that we went over in this chapter is that you could treat the foreign currency as an asset. So if you hold it without doing anything, you could uh, enjoy the economic gains or suffer from the economic loss. So, for example, we have a, a example here. It's in the beginning of the day trading market of the foreign exchange. So here, the example tells you that at 7 o'clock this morning, the exchange rate between Japanese yen to US dollar is 0.008508 in the beginning. But then 2 minutes later, the exchange rate become 0.008501. So if we're using the direct term, you could see that $1 in the beginning could only swap for 117.536 cents of the yen. But after 2 minutes, 2 minutes later, one cent amount of the US dollar, so 1 unit of the US dollar, you could exchange for 117.733 Japanese yen. So you see, like the exchange rate, it's actually fluctuates a lot, and this is the reason why if you hold the foreign currency as an asset, um, because of the price, because of the exchange rate fluctuates over the time, so you might have the gain, or you might suffer from the loss. So let's see this example. We already see this one on Tuesday morning. Is that if this guy have 300 million to buy yen in the beginning, and if this guy had the 300 million US dollar in the beginning, he could sell to the market here. He could, oopsie. He could sell to the market in the beginning by this exchange rate. And this is the amount of the US dollar that he sold in the beginning. So this is the amount of the Japanese yen he got under this exchange rate. And then 2 minutes later, the exchange rate right now become this. So using the direct term, we know that this means US dollar appreciate against Japanese yen. So Japanese yen, in other words, Japanese yen depreciate against the US dollar. So you could actually think about it. If you sold it at a new exchange rate, the total value that you get in terms of the US dollar is supposed to be less than 300 million. Why? Because in this 2 minutes, the Japanese yen depreciates and US dollar appreciate. So if you're just using the calculation that we went over in previous lecture, you can see that over this 2 minutes, this guy will suffer from holding the Japanese yen as one of his assets. So the loss for this person by holding Japanese yen is 246,000. Okay, so if this is the loss for 2 minutes, so if it's an hour, then it's 7 million loss. And if it's for one day, you just time 24 hours per day, right? Then the whole days he will suffer uh, by this amount. So if you know that the Japanese yens are going to depreciate, you shouldn't keep it as your asset. You shouldn't hold it. Instead, you have to. It's better for you to exchange the foreign currency into the US dollar. Okay, but in the end, if there is a fluctuation again happened in the foreign exchange market, and right now the US dollar and Japanese yens exchange rate become 117.435. Now, this exchange rate is actually lower than the original exchange rate. So that means the Japanese yens appreciate against the US dollar. So if you're holding the Japanese yen in this time, if you didn't sell it at 7:02, instead you sell it at 10 o'clock, then this is the amount of the money that you could get. So if you sell it at 10 o'clock, you actually could gain by 259,000. So you see the market is dynamic, it's fluid. So the timing of the buy and sell, it's very important. Okay, then we move on to the topics of the on a Tuesday morning. So we introduce the market of the foreign currency and the market of the US dollar. So we introduce the forces in the supply side and the demand side. So as we know that in economics, when you're trying to construct a market, the most important thing is that you have to figure out who is the suppliers in the market and who is the consumer or like demand side in the market. So we are taking take a look of the foreign exchange market, but now we are taking into the US dollar market. So who is the supply side of the US dollar? So first, it's the importers from the US, right? So for example, if you own a coffee shop, you would like to buy the cheese from Europe, then you would like to exchange your US dollars to euros, right? Because those firms, those targeting firms that you would like to buy from, they only accept the currency in their country. So they are not accepting the US dollar. So you have to go to the bank to exchange your US dollar to euro. So by the meaning of the exchanging, that means you are selling your US dollar in order to exchange for some of the euros. So you buy the euros, you sell the US dollar. So that's the reason why the importers in the US are the supply side of the dollar in the foreign currency market. Secondly, domestic savers who would like to buy foreign assets, it's also the supply side of the US dollar in the foreign exchange market. Why? The reason is the same. If you are trying to buy assets overseas, they only accept their currencies as the payment. So you need to sell your US dollars in return for the foreign currency. So by doing so, you are the supply side of the US dollar market. Then on the other hand, the demand side of the US dollar will be just totally opposite. Right now, if you are the US firms, for example, DuPont making a solar panel and sell it to overseas, and when you sell it to overseas, you will receive the foreign currency, right? Um, and now, if you want to make the deposit back to the US, you would like to sell those foreign currency and to buy the US dollar. So those exporters, US exporters, are the demand of the US dollar in the foreign currency market. And on the other hand, the foreign savers who wants to buy domestic asset, it's also the demand side of the US dollar market. So for example, if the overseas investors, they would like to buy the real estate in the US, first things they need to do is to exchange their currency into US dollars, right? So they are demanding, they are trying to buy the US dollars on the market. So they are the demand side of the US dollar. So as we went over this in Tuesday's class, you could see that if the demand of the US dollar is increasing, so that the price of the dollar will goes up, right? The basic principle in economics, if demand is higher, then price will be driven up. And in terms of the if we're using the international economics terminology, the price of the dollars goes up. That means the dollars appreciate. And if we're using the graph here, this is the direct exchange rate between Chinese yuan to US dollar. You could see the appreciation trend. It looks like this. Okay, last but not least, we talk about the exporters, the perspective from the firms, and from the perspective of the asset. Then the last one is from the perspective of investment or the speculators. So people whose job is doing the trading of the foreign currency, we call them speculators. So if the people who thinks that dollar will be worth less in the future, they would like to get rid of the US dollar. So they become the supply side of the US dollar market, so foreign exchange market, but we are talking about the US dollar. Whereas the speculators who thinks that dollar will be better, like they are very optimistic of the US market, they will like try to hold more, they would like to exchange their foreign currency into the US dollars. So we already go over those two examples in the class. And then just like the like other markets in Micro 101, so since we already construct the demand side and the supply side and the demand side, right? Like the three parts of the supply side and three parts of the demand side. The next things we would like to do is doing an analysis to finding out the equilibrium price and the equilibrium quantity. So using the previous example, we are looking into the price of the US dollar. So in international economics, this terminology is just called exchange rate, right? And by the convention, we use the direct term because the price and direct exchange rate from the US citizens' perspective, they are going to the same direction. The price of the US dollar goes up. That means dollar appreciate. If dollar appreciates, the direct exchange rate of US dollar appreciate, right? And on the horizontal axis, it's by the convention, it's the quantity, right? The quantity of the asset. And here it's exactly the same. So we are looking at the dollars in the foreign exchange market. So now we already have a pretty basic supply and demand and the whole market of a simple model for the US dollar market. So that's just think about how do we utilize it to analyze the behavior of the market. Suppose the interest rate raise in the US. So interest rate in the US, you will attract more overseas speculators, right? So one of the things that will correlate it with the interest rate is the national bonds of the yield of the national bonds of the US, right? So you will attract more people from outside of the US trying to buy the US national bonds because the yields is better. They pay more if you hold the US national debt. So people living outside of the US would like to buy more US national bonds. So the first things they would like to do is to sell their foreign currency and to exchange for the US dollar. So the demand of the US dollar will increase in this regard. So if the demand increase, that means the demand curve shift upward or rightward, and it will driven up the price. So the dollar will appreciate in this case. Suppose US run the trade deficit with Japan. So what does it mean? It means increase import, increase the supply of the dollar in the foreign market, right? Remember that the importers, they are the supply side of the US dollar, right? So the trade deficit means the exporting is smaller than importing. So import it's larger. So import increase. So import increase the supply. If the import increase in the US, the supply of a dollar will increase. So if supply increase in the market, that means the supply curve are going to shift rightward, right? So in this case, it creates an excess supply of the dollar. So if the supply curve move rightward, these are going to be the excess amount of the excess supply of the dollar on the market. So going back to the microeconomics, if the market has an excess supply, the price of the goods will goes down, right? So this is part of the Adam Smith's invisible hands idea. You have excess supply, the price of the goods supposed to go down. So the price of the US dollar goes down, and in terms of the international economy, it means depreciation of the dollar. So depreciation of the dollar, in other words, means the value of the yen rises, right? So yen appreciates against US dollar, whereas US dollar depreciates against Japanese yen. Okay, as yen appreciates, Japanese export become more expensive in the US. All right. So then this, if the yen appreciate, will hurt the exporting firms of the Japan. So in order to reduce the impact, so this term you could just treat it as like reduce the impact of the appreciate. The Bank of Japan, it's the central bank or the Federal Reserve in Japan, they will try to intervene the exchange rate. So how do they do so? For example, in the market, we see that the demand it's become higher right now. The demand of the US dollar become higher right now. So for the bank, in the market, you can see that there is an excess demand for dollar, right? So it's this part, excess demand for dollar. Let's see if I can call out my marker. So this part, it's the excess demand of the US dollar, right? So by the economic 101, we know excess demand will driven up the price of the good, right? So this is supposed to causing the dollar to appreciate. But if dollar appreciate, this will hurt the Japanese exporting firms, right? So this is why the government has to step in to intervene the market. They don't want the dollar to appreciate too much. So what they do for the Japanese central bank, they are going to create a similar amount of the expansion in the supply. So this is the graph that the uh, the central banks in Japan to intervene the exchange rate between Japanese yen and the US dollar. So you could see that originally the yen per dollar is decreasing. So that means Japanese yen was appreciating at that time, but the Bank of Japan just step in and then to make the exchange rate between Japanese yen and US dollar uh, back to like higher level. But we see that this kind of the effects are tentatively to become a short-term effect. It's not a long-term one. The market force will, in the end, still counter back the policies intervention. Okay, so this kind of intervention, we call it the fixed or the peg exchange rate. So from the perspective of the central bank, in every country, they would like to keep the exchange rate between their domestic currency and the foreign currency regularly at at a, a a certain level, because that's better for both importer and exporter. Remember that if the domestic currency appreciate, if the domestic currency appreciates, that will benefit the importers but hurt the exporters. Whereas the domestic currency depreciate, it will hurt the importers but benefit the exporter. So for the government, their best way to do the policy is to keep the exchange rate stable. So that's why we call it some of the system a fixed exchange rate system or peg exchange rate system. Okay, so here's one of the example. So if the Japanese central bank, their target of the exchange rate between yen and dollar, it's a dollar equal to 100 yen, but the market rate is a dollar equal to 90 yen. So if this is the case, then what happened will be in the market. So people will deposit like $100, went to the banks in Japan and tell them that because the the governments are telling us to the exchange rate is 100 yen to dollar right now, so I could get 10,000 Japanese yen because of the peg. But however, if I exchange this $10,000 into the market with somebody else except for the Central Bank of Japan, how much I could get? I can get 111.1 US dollar. So this kind of the behavior, we actually call it arbitrage in economics. Like if there's a gap between the buying price and the selling price, people would like to do so, right? So if everybody doing this kind of a behavior to the Japanese bank, um, over a period of the time, Japanese central bank will no longer have any reserve in their domestic market because people wants to hold the Japanese yen, right? So that will cause a big problem. So this kind of a peg cannot be sustained in a long time. So, like I said before, the country's goal is trying to stabilize the exchange rate. And it's easier if you have a band. So it's like if you have a lower bound and an upper bound of the exchange rate. Okay, so what does it mean? It means, say that the current exchange rate is like 100, but I set a upper bound of the exchange rate become 102.5, and lower bound it's like 97.5. So you see, you have like some of the gap here that could make the exchange rate fluctuates in the market. So within the band here, the government will just follow the market equilibrium. But if it's outside of the band, the government will step in and intervene. Okay, so here's one of the example. Suppose the US was pegging a dollar to yen. Okay, US, we are stepping the shoes of the Federal Reserve. Okay, as if we are Jerome Powell right now, and demand for the dollar strengthen. Okay. So if the demand on the market somehow demand for the US dollar somehow increase, so the demand for the dollar strengthen. So this could be due to a lot of the reason, right? Like the investors living outside of the United States believe that US has a very prosperous economics in the near future. So they would like to swap their foreign currency into US dollar so that on the market the demand is strong, so demand curve will shift rightward like this. So this is the price in the market equilibrium, which is higher than the upper bound of the band, right? So here it's higher than the band. So this is not the US Federal Reserve or US central bank would like to see, because if the US dollar is too strong, once again, it will hurt the US exporters, right? Even though it benefit the importers, US importer, because one US dollar you could buy more foreign goods, but for the exporter it's opposite, right? Your costs become higher because the US dollar appreciate. So what will the central bank, the Federal Reserve, the government, the U.S. government do, they will try to step in by increasing the supply of the US dollar. Right? So US central bank, the Federal Reserve, could intervene by selling the dollars for yen. Okay, so you could the US the Federal Reserve, they will uh, get rid of their current holding of the Japanese yen. Oh, sorry, they will um, get rid of their current holding of the US dollar in exchange for the Japanese yen, so that the supply curve of supply of the US dollar will increase in the market. So you see, previously it's because we somehow had a high demand in the market, so that give us like very high price of the US dollar. So the government step in and they sell dollars in exchange for Japanese yen, right? So they buy Japanese yen by using their US dollar. So on the market, the US dollar will become more. So that's the reason why the supply of the US dollar shift rightward. And now, because the supply increase, the price of the dollar will going down, and eventually going back to into the band that they wish for. But for the governments to intervene, it's much easier to put a ceiling above a currency than it put a floor on the one. Okay, why is this? Think about the previous example. So it's easier for the US government to provide uh, their currency, right? So US dollar, it's the US government's currency. So it's easier for them to buy the foreign currency by using their domestic dollar. Whereas, like, if you're trying to reduce the supply side of the, like, to shift the supply side of the dollar, it might be a little bit difficult, right? Because you don't have, usually the government, the US government doesn't have so much amount of the foreign currency. And if you wanted to reduce the supply of the US dollar, you need to sell your foreign currency in exchange for the US dollar, right? So like the contraction part of the supply is not as easy as the expansion part of the supply. That's the reason in this slide it tells you that to sustain the packets are symmetric. Okay, so if we put in a ceiling over the currency, the exchange rate is above the top of the band. So this is the current market, and this is the exchange rate band here. So we could easily to make the equilibrium back into a band by shifting the supply side rightward. But if now we are encounter like the market equilibrium right now, it's below the lower bound of the exchange rate band. So for the Federal Reserve, the only way you could do it is to change the supply of the dollar on the market, right? So now you need to use a contractionary supply policies, the foreign exchange, the foreign exchange policy, the contraction policy here. So you have to move the supply curve backward or like leftward, so that your equilibrium exchange rate will shift back into the band. But this is not easy, right? This is not easy. And if you're using the demand side to uh to achieve this goal, demanding more of the domestic currency enforce the ceiling. All right, so it's easier for the bank to doing this policy than doing this one. That's the point for this couple slides. So we move on to the next topics. We already finished the market analysis of the foreign currency market. So now we are talking about why do countries get foreign currency. Okay, so foreign exchange reserve are holding of the foreign currency by a country's central bank. So in the US, this is the job of the Federal Reserve. So why the country they hold a foreign currency? Because trade is not balanced, right? So if you have a trade surplus, it means your export, the total value of your export is larger than the total value of the import. So you will have more firms, the firms that you get, the goods, the money that you receive from the foreign firms are larger than the money that you give to the foreign firms. Secondly, if you're holding the foreign currency, you could attract the foreign funds. Okay, so you could sell a domestic asset for foreign currency. And also the currency swap. Okay, and now we are moving to one of the application of China of the government intervention in the foreign exchange market. So there's an argument that China managed the exchange rate. And why is that? Because we know that China runs the largest trade surplus with the US. And if you are encountering a trade surplus, it's supposed to have a force in the market that push your currency. In this case, it's the Chinese yuan to appreciate against the US dollar. But the Chinese government doesn't want in this argument, the Chinese government intervene the exchange rate because they doesn't want the Chinese yuan appreciate against the US dollar, because if the Chinese yuan appreciate against the US dollar, it will hurt the exporting firms in China, right? So that will make the Chinese good more expensive in the US. So it will hurt the exporting firms in China. So they supply more yuans to the foreign exchange market to mitigate its gains against the dollar, right? So they fix the exchange rate so that the Chinese yuan and the US dollar will remain at the same level for a period of time. So basically, they just pushing down the value of the yuan so that they could still have the trade surplus um, for a long time. So as you can see, this is historical data of the yuan dollar exchange rate started from 2018 to 2022. So like we said before, this is also one of the case of the foreign exchange rate band. They somewhat just between 6.2 and 7.2 for the yuan to the dollar exchange rate. And there was only 14% differences between highest and lowest value over this period. Over the same period, there was 42% differences between highest and lowest value for the yen dollar exchange rate. So like the fluctuations of the yen dollar exchange rate is relatively small during this time. Okay, so lastly, we are talking about the new concepts. We are going to discussing a new concept. It's called real exchange rate. So previously, when we talk about the exchange rate, it's so-called a nominal one. So nominal one, it's the trading ratio for two countries' currency once again. But what about the real one? So going back to our previous chapter, we talk about the price level. So there's one of the term called nominal interest rate and real interest rate. It's pretty similar here. So whenever there's a real terms in economy, it means like we are measuring in terms of how many goods that you could buy, right? So when it comes to the real terms, it means you have to take into account of the price level. Okay, so the real exchange rate is the trading ratio for two countries' goods. Okay, so one of the example here, the nominal exchange rate, we have 1 euro is equal to 1.2 dollar in this case. Okay, so suppose the home country's prices for equivalent bottle of a champagne are $8 and 10 euro, right? So based on the nominal exchange rate, it's supposed to be like what? The dollar price of the French champagne is supposed to be $12, right? But somehow, like in the US, the same bottle of the champagne only costs $8. So with $8, I could get either one full bottle of the US champagne or 67% of a French bottle. So it's 2/3 of the French bottle. So this is the real exchange rate between the US and French. It's between the US and France, between the US dollar and euro. So we are not measuring in the dollars or the euros. We are measuring in the bottle of the wine. So from the US perspective, an equal trade would be 1 US bottle for 2/3 of the French bottle, right? So now this is the idea of the real exchange rate. We are not using currency as a unit. We are using the goods as a unit, right? So by using the goods as a unit, we take into the account of the price of the goods. That's the important idea. So this means what? This means the real exchange rate for a bottle of a wine is 2/3 between US and France. How do we calculate this one? Numerator here is $8. One American champagne, it costs you $8, right? So this is supposed to be like a divisional sign, like $8 per American champagne. And here, a French champagne supposed to equal to $12, 12 US dollar. So if you cancel out that dollar, you could figure out this ratio, it's equal to 2/3. And what are the rest of the unit left behind? It's the French bottle per American bottle, right? So if we write it as a mathematics, it's more like this. $8 American wine. And this is $12 for French wine. Okay, so if we cancel this one out, we could find this ratio is 2/3. Okay, and what are the unit left behind? It's French bottle are going to be in the numerator, right? So 2/3 of a French wine, it's equal to 1 unit of the American wine, right? So if you write it as this way, you could see like 2/3 of the French bottle, it's equal to 1 American bottle. So if the two champagnes, two wines are identical, who has the advantage in international trade? So for the same amount of money, one could buy 1 bottle of the French or 1.5 bottle of the US wine. So for here, who's supposed to have the advantage in international trade? So if you consume an American wine, you have to give up 0.7 French wine. But if you consume 1 bottle of the French wine, you have to give up 1.5 American wine. So the opportunity cost for consuming the French wine, it's higher. So in this case, America has the comparative advantage in producing the wine. Okay, so in microeconomics, we compare the prices of all goods in 2 countries. So real exchange rate is defined mathematically by this term, right? So this E means the nominal exchange rate. So this is the direct terms that we have from the perspective of the US citizens. So this E is $1 US dollar could exchange for how much amount of the rest of the world's currency. And the ratio that we have in the end, it's PD over PROW. So PD is the price index for domestic country, and PROW is the price index for a foreign country, or like the rest of the world is the acronym for ROW. So the real exchange rate in this case, if we have nominal exchange rate between the US dollar and euro, it's 0.83, and the US dollar for the wine, it's equal to $8, and the same bottle of the champagne, it's cost 10 euro in France. This will give me the real exchange rate, and this is exactly what we have in the example that we just discussed. Okay, so when the real exchange rate falls, the US goods become cheaper relative to the foreign goods, right? So this basically are just identical to the nominal exchange rate. If the real the nominal exchange rate fails, that means the US currency becomes cheaper, right? But the real exchange rate fails, that means US goods, in this case, it's the bottle of the champagne, become cheaper relative to the foreign champagne, right? And then on the other hand, if the real exchange rate rises, let's go back to the nominal first. When the nominal exchange rate rises, that means the US dollar become more expensive in compared to the foreign currency. So when it comes to the real exchange rate rise, that means the US goods become more expensive in compared with the rest of world's goods. Okay, so it's the same thing like when the nominal exchange rate depreciates, US price fell relative to the foreign price. Uh, the the foreign prices raises relative to US prices. So if the nominal exchange rate depreciate, that means the US goods are more competitive, right? So if the nominal exchange rate depreciate, that means the US firm is more competitive. But the real exchange rate depreciate, that means the US goods, it's more competitive. Okay, then we are going to the last part of this chapter. We are going to introduce you one of the important theory in the international economics. This is so-called purchasing power parity. Okay, so parity means just equivalence between a country. So it's based upon the law of the one price, which suggests that identical goods should sell for the same price in all locations. So the price for identical goods, certain goods, the price that it sells in the U.S. supposed to equal to the price that it sells overseas. So here's one of the example. Suppose I think this is egg. Like in the west coast of the US, 1,000 of the eggs cost $2. Whereas in the east side of the east coast of the US, this the same amount of the eggs only costs $1.50. So if this is the case, what happened? There will be a lot of the firms or people who would like to make money to buy the eggs from the east coast side and sell it in the west coast of the US, right? So you could have the game of the 50 cents per dozen of the egg, right? But this will not be a long-term equilibrium in the market. Think about if more people are buying the eggs in the East Coast and ship it to the West Coast of the US, what would happen? The demand of the eggs in the East Coast will become higher so that it will driven up the price, right? Whereas in the West Coast, more supply of the eggs are the supply of the eggs increasing. It's increasing in the West Coast of the US, so that the price in the West Coast will drop, whereas the East Coast egg price will increase. So this is exactly what will happen. So when the market in a long-term equilibrium, because we know that the transportation from the East Coast to the West Coast in the US is quite smooth. There's no problem for you to hire a truck driver to ship those goods from the East Coast to West Coast. And it's right. So this two market in the long run, the differences between the prices will be eliminated. So this is so-called the market power, right? So the arbitrage opportunity between two market who is connected, it's not supposed to happen. It's not supposed to exist. Because if you know there's a arbitrage opportunity, there's a discrepancy of the price in the market. In the end, the supply and demand will will adjust and make two markets their price become the same. So this is the idea of the law of the one price. So if you could ship the goods easily, we have a very important assumption here. It's what? It's the transportation cost between the West Coast and the East Coast. It's zero. So if we are not calculating the transportation cost between those two, if I found that the 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 egg in the East Coast is cheaper, I will buy the eggs in the East Coast and sell it to the West Coast. So that this arbitrage behavior will make the price in both of the market become the same. Okay, so PVP require that a currency must have the same purchasing power in all countries. It should be able to buy the same amount of goods in any country. So in terms of the international economics, we are saying that if we are talking about the currency, we are talking about the US dollar. If we could buy this amount of the goods in the US, if the PPP holds, that means by using the same amount of the money, I can buy the same amount of the goods in the Europe or anywhere else in the world. Okay, so implication of the exchange rate in a way under the PPP, the real exchange rate should be equal to 1. So if the champagne is identical, the champagne I bought from the US supposed to could exchange for the similar the identical bottle of the champagne from France. Okay, so let's take a look of an example. The Mexico peso and US dollar nominal exchange rate is 20 pesos per dollar. So this is the nominal one. Okay, so now the beer here, the US price is $1.25, like 1.25 cents, $1.25. And equivalent to Mexican price supposed to be this, right? So 20 times 1.25. So that's supposed to equal to 25 pesos. So the real exchange rate here are going to be equal to 1. So 1 US beer could exchange for the same beer I buy from Mexico. So under the PPP, nominal exchange rate should adjust to ensure the real exchange rate is equal to 1. But here is one of the example that the PPP sometimes does not hold. So for example, here it's the Apple's iPad Nano standard. So in the US price, it's this. And local price in terms of the US dollar, it's here. And by adding the information of the nominal exchange rate, we could calculate out the real exchange rate. So what does it mean here? It means if I buy a iPod Nano in Argentina, I could buy 2.31 iPod Nano, the same iPod Nano in the US. Again, in Australia, this ratio is 1.16, and in Brazil, this ratio is 1.39. So you can see from this graph that the real exchange rate does not equal to 1. And why this happened? Why the law of the one price or the purchasing power parity does not hold? First of all, it's the we are relying on a big assumption. It's not a very ideal assumption. Many goods are not easy to trade. That means what? That means the transportation it's costly. So those goods shipping from the California to the rest of the world, it costs the money to ship. And sometimes the tradable goods are not always perfect substitute. So people they thinks that the US goods are better to buy it from the US market. So they have the preference. And also the barrier to trade. So all of this reason will cause the law of the one price or the purchasing power parity broke. Okay, and then we are moving toward to the last part of the next lecture. We're going to talk about the balance of the payment. But before then, quick wrap up of the contents that we already discussed. So a decline in nominal or real exchange rate stimulates the export and retards imports. Okay, so appreciation of a domestic currency will help the exporting firms, but hurt the importing firms. Okay, so depreciation means nominal exchange rates decrease, right? So if nominal exchange rate decrease, real exchange rate will decrease. Export are relatively cheap and imports are relatively expensive. So for the exporters, they are better because their goods, their costs, it's lower. But for importers, it's not good because the cost for them to buy the goods outside of the country, it's gonna be higher. Same idea if we think about like the increase in the nominal and real exchange rate. What does it mean? It means that the domestic currency appreciate. If the domestic currency appreciates, it will stimulate the import, right? So the same amount of the domestic currency, you could buy more goods overseas. But for the exporters, it hurts because the cost right now it's larger. So the punchline here is the importer like a strong currency and the exporter like a weak currency. Okay, so the last part of the lecture, we talk about one of the accounting terms is called balance of the payment. So balance of the payment is a record of a country's economic interaction with the rest of the world and separate into two parts. One is called current account and one is called financial account. So current account have like three factors here, three categories here. One is called net export, net factor. Another is called net factor payment and unilateral transfers. And on the other hand, for the financial account, it's the same thing. You have three different categories under the financial account. So on the left hand side, this is about the goods, right? So this is about like the trading goods, the exporting and importing, the factors, and the unilateral transfers. And the financial side is here. So like the FDI or like the foreign domestic invest that's so-called FDI and the financial investment. It's in the right-hand side. Okay, so that's just the terminology. So net export, it's the differences between export and imports of goods and services. The net factor payment, net flow of the earnings between the domestic country and the rest of the world. So it means like the wage of the foreigners or the wage of the U.S. citizen that work outside of the U.S. And it also includes the earning on the assets, for example, the interest, the dividends. And unilateral transfer is just the payment that the country citizen, for example, U.S. citizen, send it to the other countries. So the most salient example is the remittance. Okay, so if you take a look of the accounting book, you will see something like this: the exports of the goods minus, so this is a negative term here, minus or like plus negatives of the importing goods, it will become the total amount of the net exports. And if you added the net factor payment and the unilateral transfers, the total amount will be your current account balances. So the other side of the balance of a payment is called the financial account. So remember that in the beginning of this chapter, I told you that international trade and international finance are the flip side of the coins. You are shipping goods to the other countries, and at the same time, you are receiving the payment from them. Or you are buying the goods from the other country, you become importers, then you're receiving the goods from them, you are going to make a payment to the overseas. So the financial account here, it's the payment, it's the cash flow. So financial account, it's the differences between financial inflows and financial outflows, right? So the current account is the trading services and goods inflows and the trade outflows. Okay, and capital account, it's the one-way transfer of asset between countries. And a settlement, it's the transaction of the financial asset between the central banks of the countries. Okay, so if you open up the accounting books, you can see that this three terms will be if you sum it up, it will become like the financial account here. So outflow, it's a minus sign, inflow, it's a plus sign, and added the derivatives, the financial account is equal to this amount of the number. And plus capital accounts and official settlements, you will get a total amount of the financial account or capital account balance. So the balance of a payment, okay, theoretically, the current account plus capital account or financial account supposed to equal to 0. So that's the reason why it's called balance of payment, because those two are balanced. But in the end, we will see in empirically, this is not always hold. So why does this the balance payment always hold? So think about that. If there's a transaction and a U.S. citizen purchase the French cheese for $100, what does the French supply do with the dollars? So for the French supplier in this transaction, for him, in terms of the goods, right, like it reduced $100 in a U.S. asset, right? Because it give the cheese this goods to the US buyers, right? So this negative 100, negative 100, negative 100, it's the value of the goods. But in return, he got 100 US dollar, right? So for him, the financial account in the friends, this turn is 100, this turn is 100, this turn is 100. So if you sell it to the US, you will get the money to the friends. That's the idea. So theoretically, the current account and the financial account, they should offset each other. However, because lots of the reason, one of the reason probably is the deferred payment, right? So people will not pay full amount of the money at a time when the transaction begins. So if you have the deferred payment, the balance of the payment at at a certain point of the time will not hold. So this is one of the case. What we calculate out in the previously, it's the U.S. balance of the payment in 2021. The current account balance is it's negative 846,000. But the financial account, it's only 738,000. So there's a differences between the current account and the financial account. Okay, and last but not least, if would like you to let you know some of the terms that it's usually it's easy to get confused in terms of the in the international economics. So when we say the balance of a trade, we only talk about trading goods. So balance of a trade, it's easy. So it's just export of the goods minus import of the goods. So it's the goods outflow minus the goods inflow, right? But when it comes to the net export, it means the export of the goods and services minus import of the goods and services. And the current account balances is this balance of the payment, it's current account plus the financial account. Okay, so here's one of the exam question that you can practice by yourself, and the answer is attached too. So basically just apply the formula of the real exchange rate and just calculate it. Right? Remember that appreciation of the domestic dollar, it's good for the importers but bad for the exporter. But depreciation of the domestic dollar, it's bad for the importer but good for the exporters. Okay, and that will be the end of today's lecture.